as you're thinking about retirement withdrawal strategies, it always becomes easier the less forced payments that we have. So the more debt that you can take off of the picture, the less forced spending that you have, the easier it is to start implementing what would be quote unquote an optimal withdrawal strategy.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business. The advisors discuss some of our firm's investment processes. These are just a few of the many possible approaches to investing. Individual results may vary depending on your goals, risk tolerance, market conditions, and other personal factors. Please consult a qualified financial professional before implementing any investment strategy.
Welcome to the Market Moment. This is Matt here with Isaac. Hello. You ready?
Yeah, I'm great.
And Eli.
As always, excited to be here.
So we've got a interesting topic for today, and one that's not necessarily, it doesn't really have a right or wrong answer. There's different ways to go about it, arguments for a bunch of different ways to do it, and that is, what's the best withdrawal strategy in retirement? So like how should you, how can you, how do you take income out when you need to start living off of your portfolio?
Yeah. And in the financial planning space, even if you go through certified financial planning coursework, they're going to list out several different retirement withdrawal strategies. There's many different ways you can skin that cat, which is a funny saying, but there's many ways that you can skin that cat. Today, what we want to focus on and what we want to talk through is each one of what could be a proposed retirement withdrawal strategy, some of the pros and cons, and then one of them that I think is a good idea that's basically impossible to do, or there's very few people that would implement it.
And there's going to be different strategies that we don't talk about today.
So stick around to the end for that strategy.
Okay. All right, Eli, you are leading this conversation.
so the first withdrawal strategy is the one that if you Googled how much can I withdraw from my portfolio, this is almost always going to be the first thing that pops up, and that's the 4% withdrawal strategy. So this was built and designed back in the 1900s based on a 50-50 portfolio, so 50% stocks, 50% bonds. How much could you withdraw? And it give you a high percentage chance that you don't run out of money over a 30-year period. And that developed this 4% rule. So what it means, if you had $1 million in year one of your retirement, you could withdraw $40,000 or 4%. And then adjust that number, that $40,000, up with inflation each year until 30 years later. So if inflation's 2%, you take $40,000 and add 2% to it times 1.02, and then you could distribute that the next year. So this is probably the simplest of
It's a good like rule of thumb. Like you want to do back of the napkin. Like, hey, what could my portfolio, spit off? Mm-hmm. Like this is a good way to do it, but probably not the end all be all.
Right. And it also is, it's very conservative, right? And there's actually a very cool chart that I don't know if we can put up or not in post, but it shows if you increase that withdrawal rate for 4.5%, the probability of going down and how much more risk you have to take to achieve those results.
Mm-hmm. Well, we went through, from the last 15 years with the rates at near zero, there was a lot of argument, myself included, saying like the 4% rate's like not sustainable. Like, because the 50% fixed income, whatever else it is like, isn't giving you anything.
Was earning 1%.
Yeah. And so it's like, man, that's probably like a 3% withdrawal rate.
Mm-hmm.
Seriously. And so now we've got fixed income participating a little bit more and rates are back up. And so I think, the 4% is a little easier to wrap my mind around. But, that's why I say it's a good back of the napkin, but it's not the end all be all, because if you retire in the next 15 years right after retirement, rates are at zero. Mm-hmm. It's like it may not work for you just to do a simple 4% calculation.
Yeah, the way that I find myself using this for clients is a lot of times my people who are not in retirement, but we're projecting out 10 years.
Yeah,
like we're just kind of penciling in what your portfolio could be and what that lifestyle might be. Or
I get the question a lot of like, well, what should my portfolio target be? Like, what do I need to try to get my portfolio to? If I know what they want if I know what their expenses are, right, then you just back into quickly. It's like, well, to give you the income using the 4% rule, you need to be around $2 million or whatever that is. And so that's a good kind of use for it too.
And there's a couple things about the 4% rule that in practice are a little bit more difficult. one of the things that I think is most difficult is that would mean that you strictly take the same income, no variance over any period of time. And I don't know anyone that we meet with that takes the same, or has the same lifestyle from year to year. There's car purchase years. And if you strictly followed only the 4% rule, you would restrict yourself from the ability to say, okay, this year I'm really excited to take a family trip, or this year we need a new car and we're going to have to spend a little bit more. So it can become restrictive. The second thing that I think of on the 4% rule is in big down years, you may or may not want to take that distribution, and you may want to adjust that. But if you have this mindset that I have to be taking this distribution plus inflation, you might be very frustrated with your retirement plan in that, because you don't have that flexibility.
Well, sequence of return risk becomes even more of a risk if you don't have a flexible kind of tactical income strategy, or at least some different ways to go about it. If you just set a plan and forget it, then all of a sudden you're one of the unfortunate ones that you retire and the next 4 years in the market are not great. It's like, well, you may never catch up, right? If you've just been taking income out. And so what's next? So the 4% income rule, very common.
You kind of hinted at it, but having a flexible spending strategy. So giving a little bit of leeway to the 4% rule. And this requires a lot of really knowing your expenses, like where can you give and take in given years where the market is down. If 70% of your income are must spend bills and expenses, well, then this is gonna be a lot harder for you. But if you're living, buying new cars every once in a while, taking lots of vacations, this will probably be an easier strategy where, hey, the market's down, we're going to take less vacations, we're going to eat out less, things like that. So again, coming back to really depending on the situation for what the best strategy would be.
That would just be stressful.
Yeah.
Because it'd be like, well, don't know what we can do next year. We'll see what the market does. I mean, that would, I wouldn't do well with that. Some people may, but you'd be letting the market drive your lifestyle and plans. And
And I think there's people out there that do live that way, though.
Oh, sure.
They come in, they see that numbers up, and it's like, oh, does that mean I can?
I'm not saying it's bad. It's just it would not work for me.
Yeah.
That strategy, so the flexible spending strategy, beckons you to try and find the lowest monthly spend that you can, so that you have the highest level of flexibility. So something like a flexible spending strategy would work very seldom with someone who has high debts or high fixed costs and low variable costs. So you wouldn't be able to have a flexible spending strategy if you have 90% of, like you talked about, 90% of your spend that has to happen with 10% variable. It would have to be someone that has a pretty variable. So this,
like the discretionary part of their budget is a 50% or a large percentage. Affords you the ability to say, like, well, we'll spend less this year, but maybe we can spend more next year.
At large, the flexible spending strategy would almost require a high net worth plan. You would have to be in that. We have a large discretionary spend. We have a large amount that's just kind of what we want to go do.
Right.
The flexible spending strategy doesn't work as well for if
lower income, fixed expenses.
Correct. Okay. The next one is one that we'll use for clients fairly often, and that's the bucket strategy. So the bucket strategy is finding several different buckets, and some people do 3 buckets, 4. I mean, you can create this however it works best for your psyche, for yourself and your own plan. But the bucket strategy takes basically 10 years, and we come up with the first 2 years of income from a really low risk or cash-like bucket. Then there's a midterm bucket, typically somewhere between like 2 and 5 or 2 and 7 years, that we may take a little bit of risk on, but we're not taking really high amounts of risk on, because that's our midterm bucket. And then there's your long-term bucket, which is your highest amount of risk, probably your highest expected return. And the goal is, as you're drawing down those short-term buckets, you're refilling those buckets with the growth from the long-term bucket.
Yeah, I love it. This is my favorite one because it's so easy to physically. I mean, when I was teaching kids in high school this type of budgeting, activity is like I would physically draw buckets, and it just makes so much sense. It's like, well, when this one gets low, you just fill it up from this bucket, and when this one gets low, you fill it up from this bucket.
So what's the hard part? What's the hard part of the bucket strategy?
In my opinion, the hard part is a long and extended period of underperformance.
Yes.
If your high growth bucket doesn't grow and you're not rebalancing, so let's say it's all stocks in that bucket and you don't have any way to manage risk for some of the downside, if you have a long and extended down period, you're not going to be able to refill those buckets on the front side with as much money as you'd like and feel comfortable to make a retirement plan.
Yeah,
last.
I think I think there's two hard parts of the bucket, and I love the bucket strategy. I think it makes a ton of sense for the right people. I think having yields higher make the bucket strategy easier because you can have safer money that works, right? But it's hard to, in a longer underperforming market and having the discipline to refill the buckets when you need to, because you can rarely just wait till the last minute and refill, and it is the right time. Yeah. And so I always talk to clients about, hey, we need to opportunistically over time, like, be replenishing this bucket, because it is rarely going to just work out where we draw this down to zero, this one's at an all-time high, we cash out and we replenish. And so just, having a strategy, have an approach to replenish as needed, not let your income bucket get too low so that when you do need to replenish it, the market just sold off 30%. It's like that's what you're trying to avoid. And so you have to be, the downside to it is like you have to be somewhat, I think, tactical or strategic about how you're refilling the buckets. If you have them built out the right way, you should have given yourself a lot of flexibility and time to do that. But that's just like any of these strategies have pros and cons and negatives. None of them are just completely bulletproof.
Well, and when the market's doing well, people hate the bucket strategy, right? Because you have a huge amount of assets in cash, you have a huge allocation to bonds, and it's like, well, this part of my portfolio is doing so well. But like you said, when the market goes down, as long as you've planned for that time, that's when people are very thankful to have that cash allocation and not have to rely on the returns.
One part that's consistently hard with the bucket strategy is that active management that you're speaking about. It sounds really nice on the front end, but year 1, year 2, you start to say, okay, now we need to refill buckets. Where are we going to pull from? What's it look like? What's the environment? And that can put some strain on an individual that's trying to make an optimal decision when there is no perfectly correct decision. And that year after year after year, if you're not okay with that, can start to put a lot of strain, whereas something like the 4% withdrawal, we're probably managing and rebalancing the portfolio whether you want us to or not. So it's a 50-50 allocation or a 60-40 allocation. That's happening likely on an annual basis, that it's rebalancing to that. You're not having to actively decide which bucket am I going to pull from to refill which bucket that I want to refill.
Yeah. So we had 4% rule, flexible spending, income bucket, or bucket strategy. What's next?
And the last one is one that's come out really in the most recent years, and this is the one that's the certified financial planning nerd strategy, and that's the guardrail strategy. So the guardrail strategy is similar to the 4% withdrawal rule with a little bit more variance for if the market performs really well and if the market performs poorly. So similar to the 4% withdrawal rule, you start with like a 4% withdrawal. Then you set guardrails. Say your portfolio is $1 million, and if it goes over $1,250,000, I'll bump my 4% to 4.5%. And if it drops beneath $850,000, I'm going to drop it from 4% to 3.5%. And then you continuously manage based on the guardrails that you set so that you keep your portfolio in a very similar line over time.
These all look really good in Excel.
They're incredible.
And when you run scenarios on them, they look fantastic.
Yeah. Straight line math, Excel. It's like, but the day-to-day real world and like markets moving, it's you have to have a strategy. So I don't say that to say like don't have, like all our clients we have strategies with. Yeah. And there's not one that works for everybody. We have clients in bucket strategies and clients in flex kind of spending strategies. And so we're very specific to the client. But you have to know that like, this is hard. Like the markets do what markets do. We can never know the timing of that, the length of a downturn, the length of a bull market. And so you can have these rules and principles and guardrails in place, but I mean, none of them are bulletproof, and it's going to be harder than it sounds like, because all these articles that we read and the data we put out there, right? You can run in Excel and create graphs, and it's really compelling stuff. But the day-to-day real world of investing is just not that simple.
In my opinion, the guardrail strategy is for the spreadsheet hero.
Yeah.
Someone who absolutely loves getting down and dirty with the numbers. If you like that, you're excited about that, and you're willing to adjust your lifestyle because a spreadsheet tells you to adjust your lifestyle, then it may be the most optimal strategy for you, because when you start to dig into it, a lot of times the guardrail actually does allow you to spend more. I did a data brief video on the guardrail strategy, and it allows you to spend more. However, you also have to have that flip side of, there are periods, and maybe for several years, where you have to spend less, and that may be right when you're really wanting to spend more.
Yeah. So that's my only hesitancy ever with the guardrail strategy is if you have that upper guardrail year, that the bottom guardrail year is going to hurt even more. Right? Like, you're like, wait, you mean I got to raise?
Yeah, I can't. I'm not going back to 4%.
I'm not going back to 4. Yeah. Yes. So you have to have a special person.
Just as important, if not more important, about how much money, how much you're taking out is where you're taking it from, right? And so I know we talk a lot about, for a lot of our retired clients, we have annuities in place, different types of annuities. Some of our clients don't have annuities, right? It's just a product that makes sense or it doesn't, depending on the situation. But a situation that, makes sense, or that I like talking to clients about is, we need to know how much money we're taking out and what the strategy is. But let's also give ourselves flexibility of where we're taking that income. And if the market's down, can we take it from an account that's not and let the market-based accounts recover? And so there's a lot more components to having an income strategy other than just figuring out the amount you can take out, but figuring out the right allocation, when to take out of which accounts, whether they're Roth or IRAs or non-qualified. So this is a pretty complicated formula calculation when you're coming up with an income strategy. The withdrawal component of it is really just one piece of the overall strategy. So any parting thoughts or words?
No, I mean, we kind of touched on a lot of it. It's almost an ever-going conversation. It's why it's important to meet regularly and take a look at your expenses and make sure you're not getting out of what you've planned for. And if you are, the plan needs adjusted. Yeah.
And so the summary was 4% withdrawal rule, the bucket strategy, the flexible spending, and then the guardrail strategy. Okay. So I probably couldn't repeat what all those are. But Eli, any parting thoughts?
Yeah.
Words of wisdom?
The withdrawal strategy, it's going to completely depend on your situation. Like we talked about the flexible spending, it fits a certain type of client picture and it doesn't fit others. So as you're working through these, there's maybe one that sounds good to you, but it doesn't work for your situation. One thing I would encourage as you're thinking about retirement withdrawal strategies, it always becomes easier the less forced payments that we have. So the more debt that you can take off of the picture, the less forced spending that you have, the easier it is to start implementing what would be quote unquote an optimal withdrawal strategy.
Yeah. What just live on air, so no pressure. But just curious. When someone asks you, I get the question all the time, what's the most important thing I could do before retirement? What's your go-to if you have one? Do you have one?
What's the most important thing before retirement?
Well, before we retire, what do I need to make sure I have accomplished? I'll tell you what I was thinking. I was thinking about it when you were talking. I've always said just have your home paid for. If there's any one thing, if we can't do it all, if there's any one thing that you want to just hyper focus on is have a paid for home. What made me think of it was because that's typically people's largest fixed expense. And so
when I first got started, Eli shared this with me, David has shared it with me, and it's something that a lot of people in the office have kind of talked about. But when you transition from your working years into your retirement years, it stops being a game of accumulation and it is strictly inflows and outflows.
Yeah.
Right. And so to your point, if you can lower your outflows, then your inflows become a lot more powerful. And then, so debt reduction of any kind.
Yeah.
I always just say if you know your expenses, we can build a good plan.
Mm-hmm.
So if you're saying, what do I need to do before I retire or before I could have confidence to help you say, like, yeah, retirement's possible, I need to know your expenses, and I need to have a little bit of confidence with what you tell me on your expenses. Because if you come in and you're like, well, I think it's this, and I'm not going to sit here and have a lot of gusto whenever I say you can go retire.
Yep.
So know your expenses is mine.
Yeah. All right. Well, good conversation. We appreciate you guys watching and listening. As always, give us a like, subscribe, share. Send us your questions via email if you have any, and we'll be sure to cover those in an upcoming episode. And we'll look forward to seeing you guys next week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.